Good morning, everyone, and welcome to today's webinar titled Deploying Capital in Nigeria, Risk, Return, and Reality, hosted by Duale, Ovia, and Alex-Adedipe. DOA, as we fondly call it, a specialized law firm operating in Nigeria. My name is Melody Bebulam. I am a senior associate here in DOA, and it is my pleasure to be moderating today's session. A few quick housekeeping rules before we get started. This session is being recorded. Please use the Q&A function at the bottom of your screen to submit questions throughout the session. We'll get to as many as we can at the end. Please keep your microphones muted throughout the session, and we are aiming to finish in about an hour. So let's just get into it. I will now hand over to our partner, Mr. Adeni Duale, here at DOA, for the opening remarks. Thank you.
Okay, thank you, Melody. Good morning, everyone. And welcome to today's webinar titled Deploying Capital in Nigeria, Risk, Return, and Reality. Thank you for joining us. We have a distinguished audience here who are made up of both investors, advisors, and market participants. And we are pleased to have them here for what we believe is a very timely and important conversation. Without doubt, Nigeria is at a critical inflection point. I mean, over the past few years, especially with this administration, there's been a lot of deliberate macroeconomic reforms, either from subsidy removal to fiscal consolidation and sector-focused capitalization. A lot of this is aimed at restoring stability, rebuilding investor confidence, and ensuring that the economy becomes more resilient, I beg your pardon. I think in addition, what I'll say is that in the last quarter of last year, statistics indicate that the GDP growth reached close to 3.98% in the third quarter of 2025. However, as many of you will appreciate, I think it's important to say that it's not just the numbers that we're looking at, right? It's important for us to have a conversation around deploying capital, especially with regards to Nigerian markets. And why do I say this? I'm saying this because in the Nigerian markets, there's a lot of opportunity as well as complexity. What this webinar is trying to do is to ensure that we move just beyond just speaking theory, but just try to engage in things relating to reality. We will be exploring Nigeria's current investment climate, as well as the impact of the ongoing regulatory developments on capital deployment. We will examine the key risks that continue to shape M&As, as well as private equity transactions in the country. We would also try and discuss practical aspects of doing deals in Nigeria. More importantly, we would highlight emerging opportunities and draw on global best practices as we see them. Our goal today is simple: to provide a clear, practical insight that can help to bridge the gap between perception and reality, especially when it comes to investing in Nigeria. Thank you once again for joining us. And at this point, I will hand over to Melody. Thank you.
Thank you very much, sir. Before we dive into the discussion for today, I would like to introduce our panelists for today in no particular order, but I will be starting with Funke Ejaya-Oladipo. Okay, so Funke Ejaya-Oladipo is a finance executive with 20 years of experience across Nigeria, hundreds of millions of dollars in capital, and led complex mergers, acquisitions, and restructurings through her work at Goldman Sachs and the Standard Bank Group. She currently serves as Group CFO, hundreds of millions of dollars in capital, and led complex mergers, acquisitions, and restructurings through her work at Goldman Sachs and the Standard Bank Group. She currently serves as Group CFO and Executive Director at UAC of Nigeria PLC. She is part of the leadership team that provides strategic oversight across UAC's portfolio of category-defining companies that nourish millions of Nigerians, employ thousands, and power key sectors of the economy, including food, beverages, paints, logistics, and real estate. Her M&A credentials are extensive, and most recently, UAC completed its acquisition of Chi Limited, that is the Chivita Hollandia, from the Coca-Cola Company, one of Nigeria's landmark FMCG transactions of 2025. Since joining UAC in 2020, Funke has transformed how finance supports strategy, driven value across UAC's portfolio companies, and deepened investor confidence. In that same time, UAC's revenue has grown 8 times from 81 billion naira to over 700 billion naira. And the share price increased 11.45 times from 8.8 naira 60 kobo to 100 naira. She serves on the boards of UAC of Nigeria PLC, Chi Limited, Grand Cereals Limited, and UAC Foods Limited, as well as the Advisory Board of Sponsors for Educational Opportunity, SEO Africa, a nonprofit focused on developing African youth into future leaders. She holds a BSc in Economics and an MSc in Project and Enterprise Management, both from University College London, and is a CFA charter holder. Thank you very much, Ma, for joining us today. Our next panelist is Stephen Osho. Stephen Osho is the co-managing partner at Commercial Partners Limited and a member of the company's executive management team, where he oversees advisory. He is a member of the Nigerian Capital Market, the Institute of Directors Nigeria IOD, a former deputy chair of the Financial Markets Dealers Association Bond Work Group, FMDA, and a fellow of the Institute of Credit Administration. Stephen also serves on the board of M778, a boutique marketing communications advisory firm, an advisory partner at iScholar Initiative and Avail Africa, a goodwill synergy platform designed for corporations and non-governmental organizations to champion causes consistent with their social responsibility. His breadth of knowledge and operational experience in team building and business growth is enormously beneficial, allowing him to contribute to Commercial Partners' strategic direction and long-term sustainable success. In 2002, he joined Legacy Stanbic Bank, a subsidiary of the Standard Bank Group of South Africa, and oversaw trading and risk management activities across a wide range of asset classes in the fixed income business. In the course of his career, he won the Euromoney Best Bond House for Stanbic IBTC as the best liquidity provider in 2008. Prior to assuming his current role, Stephen was head interest rates, products, and fixed income business. Stephen has over 2 decades of extensive experience in banking and financial services. He's a passionate change management and performance advocate devoted to the notion that organizations must take a cautious drift from conventional methodology to foment change that merits attention. Stephen has facilitated several trainings for large corporate organizations, sovereign and subnational governments, and has been active within the community to drive diversity and inclusion. Stephen holds an MBA in Finance and Sustainability from the University of Cumbria, UK, as well as a first degree in applied geophysics from the Federal University of Technology, Akure, Ondo State, and an ACI dealing certificate. He is a seasoned financial markets analyst on CNBC, Arise News, channels, and most mainstream media outlets. Stephen is an ardent soccer fan and a music lover. Welcome, Stephen Osho, to today's webinar. And our final panelist for today is Amaka Ukechukwu Obara, founding partner, Weave Capital. Amaka is an investment professional with over 18 years of experience in finance and investments. She is the founding partner of Weave Capital, a mission-driven venture capital fund that invests in gender-smart companies, spearheading innovation in the future of climate, future of finance, and the future of work. She previously worked at the World Bank on private sector development, directly managing a portfolio of over $1.3 billion in projects across sub-Saharan Africa. She has extensive experience funding and providing technical assistance to entrepreneurs, business incubators, and venture capitals in sub-Saharan Africa. She sits on the board of several companies. Welcome, Amaka, to today's session. We are delighted to have such a strong panel today. And without further ado, let's get into today's discussion. So I want to start with a question for all three of you, because I think you each come at it differently. In today's Nigerian investment environment, with everything that's happened in the macro and reform side, what does disciplined capital deployment actually mean in practice? Steve, let's start with you.
All right, morning, everyone. It's my pleasure to be here today. And thanks for giving me this platform to be able to hear my opinion and my view about this particular topic. The question you ask is actually very, very important these days. If you go back to the era of I would say from 2010 to 2020 or early 2020, I would say that the capital deployment has actually moved from what we call, or what we used to tag, growth at all costs mentality for most of the investors. These days, I think the context have actually changed a bit. I think that change in between the early 2020 and now to what I will call evaluation integrity and capital preservation. What does that mean? I think a lot of investors, in terms of deploying capital now, have discovered that if you want to focus on what we call the disciplined capital, we have to prioritize business with the pricing power to pass through all the shocks and issues within the system, i.e. inflation and all the other shocks that actually can happen within the system. And why is that? The reason is because, like I explained earlier, prior to 2020, early 2020, most of the focus have actually been on all growth. But now the movement is being placed, or the priority is being placed on pricing power and getting an investment or institution that has a very strong cash flow. So moving away from those that are reliant on subsidization or high leverage growth models, which cannot really sustain the business over the period of time. I think another thing that have changed generally is a lot of investors have looked at how investment yield or treasury bills, for example, has moved for the past few years. Prior to when we see the inflation actually coming down to the point of 15%, we've seen treasury yields on maybe like 1 year paper around 20% and above. So there's what we call the order rate realism. And the hurdle rate realism is when investors are actually looking at the capital and say, if I do a risk investment asset or risk-free investment asset in the country, especially Nigeria, that can give me 20% yield and above, how best can I deploy my capital into a situation or into an investment that can give me an internal rate of return that is quite higher than what a risk-free asset will give me? So that creates that hurdle rate realism that a lot of investors will look at when they are trying to develop or deploy capital. So that will probably be my second point. And another areas that we'll probably look at is in terms of compliance. A lot of things have changed from just going through the cash flow management or strong cash flow of a company to hurdle rate realism into something that is much more important. A lot of investment or a lot of investors will look at how the business they are going to is adhering strictly to compliance. For example, a lot of investors will look at NIPC negative list and say if any of the company they're actually investing in is on that list. If anyone is there, is actually like a big flyer for them to actually say, you know what, I'm not interested in this company because of this and that. There's a SEC revised guideline as well in terms of threshold of what the business should look at going forward in 2027 and above. And I think a lot of capital or so-called disciplined capital that are looking into that space will look at those kind of businesses that have actually met some of those regulatory obligations and compliance and see where the value is for them. So in a nutshell, I'll put it as operational cash flow focus in terms of deploying disciplined capital, and hurdle rate realism in terms of how business look at the other investment outlook or outlet for them, and strong inputs on compliance. So that would be my response to the question. Thank you.
Thank you very much for that. Amaka, you're coming at this from a VC and development finance angle. Does that resonate, or do you see it differently? Okay, so while we wait for Amaka's take on this, Funke, would you like to share your view on this as well?
Sure, thanks, Melody. Morning, everyone, and thanks to the organizers for this event. Special thanks to Nii for inviting me to share my views on this platform. Look, I think I would come at this from and try to put my practical experience, being at UAC, and when we think about disciplined capital deployment, because we do buy assets, sell assets, we also invest in the treasury markets. The first thing is the clarity of the return, because for you to be disciplined, you have to know exactly where you're going. And in simple terms, what that means is, what are your expectations? You need to also be honest about what you know and you don't know. In Nigeria, there are a lot of factors to consider, including inflation, exchange rates, the regulatory environment, the consumer's purchasing power. And these are variables that, even if you had a crystal ball, you probably wouldn't be able to be certain as to what to expect. So in terms of clarity of return, it's useful to know what are those parameters, or what is the threshold that any investment below this is essentially not worth your while. For us at UAC, we have a threshold of a 25% return on invested capital, and that literally guides every investment decision that we made. So if anyone comes to the team with anything less than that, they're essentially kicked out of the room because it doesn't meet the threshold that we have agreed as a team. And it's useful to also factor in your cost of capital when you're thinking about the return. So I guess step one is, if you're not clear on what you're expecting to get from your capital, clarify that point first, because that's step one. The second thing I'd say is being comfortable saying no, and that speaks to the discipline. There's a lot of pressure on investors to deploy capital, put your money to work, and just invest in any opportunity. Again, for us at UAC last year, we looked at 25 transactions in terms of investments, and we ended up concluding just one. So that gives you a sense of the scale of the number of investment opportunities that are available. So there is that, being able to be comfortable saying no, be selective, and pass up on opportunities that don't meet your threshold, because there are a number of opportunities in Nigeria. I think closely linked to that and being comfortable with saying no is understanding your core competence. I'm looking at the list of attendees. I'm not sure what each person's area of core competence is, if you're an institutional investor or if you're an operator like myself, but we place a lot of reliance on what you know and you don't know. For us, we would focus on, investing in companies that are market leading branded consumer goods, because that's where our area of expertise is. Once you go outside of that, it starts getting very limited, because we know that when you think about the risk in terms of capital you deploy, the execution risk increases in proportion to what you don't understand. So we try and stay in our lane. So I think I'll stop at that point.
Thank you very much for that. I don't know if we have Amaka back on. Amaka, if you're back on, we'd just like to quickly get your views on this from a VC and development finance angle, if this resonates with you or if you see it differently. Okay, I think maybe we'll circle back to her. I think she's still having some technical difficulties. So we'll just move to the next question. I think we're off to a great start. This gives us a really strong foundation. So let's get a bit specific about where the opportunities actually lie. Stephen, from a capital markets and liquidity perspective, where are you seeing investor appetite concentrate?
Sorry, that question for me?
Yes, please. I can take it again.
Okay, please.
Okay, I was saying that if we're being specific, we want to be specific about the opportunities that we actually have. And I was wondering if you could share your perspective from a capital markets and liquidity perspective, where you're seeing investor appetite concentrate in the market.
Okay, all right. So in 2026, we've seen quite well, I would say, let's piggyback to 2025, late 2025 to 2026. We've seen quite a lot of investment coming into treasury bills and government bonds, actually. And that's the reason, that's because of the elevated yield curve we've witnessed or we've seen for the past few months, because of the steep inflation number we've experienced in Nigeria. But in sector specific, if we move away from the conventional bond or instruments that investors typically look at, which a lot of offshore investors actually too can do some carry trade. We've seen specific investment in financial services and fintech. The reason for that would be because of the bank recapitalization exercise that CBN has announced, which was due on 30 March 2026, actually. We've seen the sector, witness some significant growth roughly about 30 to 35% between 2024 and 2025. And interest rates, like I mentioned earlier, has been very specific. A lot of investment has gone to that area. The bank capitalization has helped us as well, and massive digital adoption by a lot of players within the sector. And the trend has been the consolidation exercise by central bank, and a lot of digital maturation from the fintech company. So we've seen a lot of investment go through that area because we've seen a lot of improvement in digital fintech investment in Nigeria, as a lot of them have improved their cross-border payments and B2B solutions. So these have attracted a lot of investment. And at the same time, I think the financial inclusion side of the business, which has actually deepened access to unbanked and informal sector, using some of these digital tools, have improved a lot of interest from investments or investors looking at that area. Another sector that I would say will probably be, I think, agribusiness. We've seen a lot of investment flow into agribusiness in Nigeria. We've seen what Okome is doing and Fresco. We've seen the likes of a lot of other companies coming out in that area because a lot of value-added processing have actually improved or existed within that area. And we've seen a lot of export orientation or oriented industry within the government incentives that has helped those particular area. If you look at 2026 budget, for example, I think roughly about 2.3 or 2.4 trillion was marked for 2026 budget in terms of agri and technology. So that has attracted quite a lot of investment in that area. And talking about sector specificity again, I would say we've seen quite a lot of investment in oil and gas and renewable energy. I think the downstream transformation, which I'd have seen the likes of Dangote refinery and other refineries shifting Nigeria from a net importer to a potential exporter of refined products, have improved that area and has attracted a lot of investment in that area. We've seen a lot of off-grid solar renewables as well. Investment is going to that area as a lot of SMEs and rural areas due to grid supply deficits is improving. And we have quite a lot of investment tracking that particular sector as well. I think another sector that we can't ignore in terms of development and growth we've seen there has been in the area of real estate and infrastructure. I think along the Lagos-Epe corridor, you've seen what is happening there through the free trade zone, and we've seen how a lot of investments are actually tracking and moving to that zone as well. Technology and digital infrastructure, I think we've seen quite a lot of investment going to that area as well. And maybe investment in data centers. Yeah, I think maybe investment in data centers improved as well in 2026. So these are just a few of areas in terms of things that we have seen from our point, apart from the conventional investment in just equities, fixed income, and any other conventional assets.
Thank you very much. So I'm hearing in terms of opportunity, I'm hearing the financial services, the tech sector, and the agri business, as well as oil and gas. Funke, just before I move on to Funke, I just want to reiterate again to the audience. I've seen some hands up. Please just submit any questions you have to the Q&A chat box, and at the end of the session, we will definitely give some time to address each question. Thank you. Okay, so Funke, does the M&A and corporate finance deal flow you're seeing reflect that, or are you finding compelling opportunities in places that might surprise us?
Thank you. I guess I could only speak from my experience and in terms of the deal flow, and what I would typically look at is starting from what makes a compelling investment for our economy in Nigeria, and that just starts with the structural characteristics. We have a large, growing, underpenetrated market with a population of, I don't know what the latest statistics are, over 200 or over 200 million people, growing and urbanizing. The view is that as long as you have that structure in place, people will have to eat, they will have to drink, they'll have to buy basic household products, regardless of the, I guess, macroeconomic cycle. So based on that, we typically tend to be most constructive on branded consumer goods or packaged food and beverages because the demand is there. I guess the missing piece is whether those that are operating in that environment can convert that demand into what is a sustainable, I guess, profit margin. We're actually seeing a little bit of interest, I guess, in folks focusing on the healthcare and pharmaceutical industry. Again, that's also linked to the structure of the economy where you have the large population, because for things like pharmaceuticals, they're non-discretionary in the sense that when somebody is ill or requires medicine, they may go as far as even to borrow to ensure that they get the relevant drugs to help themselves. I think in terms of where folks may tend to be a little bit more cautious would be areas where the sectors are largely import dependent just because of things around the foreign exchange, whether there's volatility and what's happening in that market. But I guess to summarize, the constructive view is really, really focused on how Nigeria is structured and what we have to give as a country, which is an overabundance of human beings. I guess there's also a question around the purchasing power and how much each Nigerian can afford. But as things in the economy improve, I guess that's set to increase going forward.
Thank you very much for that. So I'm hearing basically essential services, essential sectors that, we are human beings. We always have to eat. We always have to buy medication generally. So, okay. Thank you for that. I hear Amaka is back in. Amaka, are you with us now?
Yes, I am. Sorry, I was having connectivity issues. Yeah.
All right, no problem. Welcome back. So I'll just ask the question just to get your own view on this, and then we can proceed with our other questions. So the question was basically getting into the specifics of capital deployment and where we are currently seeing opportunities. And given your focus on climate, finance, and the future of work, which sectors are you finding the most compelling risk-adjusted opportunities currently in Nigeria? And maybe what structural trends underpin that view? Just in a nutshell, basically. Thank you.
Sure. Wherever there is, whenever you find massive problems, you find massive solutions. And so that's sort of what we see at Weave Capital, and just what I see also as an investment professional. One area that I'll sort of highlight is when we think about climate, oftentimes people think it's a nice to have. But then when we look at the reality, so we recently did a study where we went to speak to many farmers that are farming, and the situation is actually quite, it's quite worrisome in some ways, but it also provides a clear opportunity in the space. So you see yields are coming down. There is, climate change is affecting yields, right, in a very, very massive way. You see that there's a clear market for things like insurance around agriculture. There's a clear need to really think through moving away from the traditional seeds to maybe more bio-fortified seeds as well. You see that there's a need for irrigation. So anyone that can really think about how to provide smart irrigation in a way that you can ensure that the farmers can pay, because the ability to pay is a real reality. So we're seeing opportunities where there are problems. So when we think about climate, we're seeing massive opportunities in smart irrigation, in inputs financing, and people that are able to do that well. In addition to that, when you think about the current state of the economy and even the current wars, you see that the price of oil is going up. And we're at this inflection point where the cost of production using oil-based products, whether it's petrol, diesel, is going up massively. And on the other hand, the cost of whether it's solar panels are going down, the cost of battery technology is going down. And so we're at this inflection point where people are actually fighting to switch to solar. We spent March speaking to keke riders in Lagos, and a lot of them are actually looking for solar alternatives. Not necessarily solar, but effectively whether it's lithium battery powered alternatives, because the cost of actually maintaining, paying the person that they're paying for the actual keke, and also paying the fuel costs are just punitive. And so they're not able to actually make profits. And so what we're seeing now is actually there's a lot of, I think there's a lot of opportunity in e-mobility. And so that's one that we're actively looking at, and we're about to close an investment there. We're also seeing massive opportunities in C&I solar. So really, when you look at solar, we found that the best sort of the sweet spots in terms of ability to pay is when people are using solar for productive use. And so we're seeing a lot of opportunity in that in terms of the financing and people that are able to do some level of assembly and supply of these solar products. So that is, I would say, the key opportunities. Those are the key opportunities that we see in some of these spaces. Another one that I think is very important in the fintech space is fraud. Fraud is on the rise, and there is a huge opportunity for anyone that can really solve the fraud situation in payments in a sustainable way that is not too punitive to the fintech providers. And then the last one I'll say is hardware. It's not expected for a VC to say hardware, but I think there's a massive opportunity in hardware, actually. And so we're looking for companies that are building not just software, but hardware as well, as a note.
Thank you very much. I think that you and Stephen are aligned on the sectors that we are currently seeing opportunities in. Okay, so still a bit on it. I'll just try to speed up because I think that we are, it's now past 11, so I'll just try to speed up as much as possible. So let's zoom out for a moment. We've talked about where the opportunities are today, but I want to think about the longer arc. Amaka, looking ahead 5 years, what conditions must be in place for Nigeria to consistently attract large-scale institutional capital and, not just episodic interest, but sustained conviction?
Yeah, I think, in terms of just investments, the biggest thing everyone is thinking about for an investor is, if I put my money in, can I get my money out, right? We've solved one of the problems, which is around, the unification of the FX and having a clear FX regime where it's floating, and there's predictability, right? However, the reality is that we're not fully there in terms of there are quite a few FX controls at the banking levels as well. So you don't just have to ensure that there's a floating or some sort of like predictable FX exchange regime, but there's also a need to ensure that FX controls at the bank levels are removed, right? If you try today to go to your bank and say, hey, I want to move $500,000 or $2 million outside the country, even if you're able to sort of show where that money is coming from, do all the AML checks, it's extremely difficult. And so if you're not able to, if you don't have that free flow of money in and out, then it creates a problem. So FX controls have to be obviously safely removed, right? In a way that you're ensuring that you're doing your KYC, AML checks, but you also have to ensure that there's a free movement of money in and money out. Another thing that's important is inflation. We talk about the macro, and it seems like, yeah, the macro is trending right, but the reality is there's lots of structural things that still need a lot of improvement in the macro. When you have double-digit inflation, that's not good. And we're going to see inflation now rise with the rising cost of fuel, and that's a problem. It's a huge structural problem because it affects everything. If you think about pension funds and the fact that the average pension fund is putting in money, and your T-bills, you're getting what, 19-20%, and then on the other hand, your inflation is in double digits, you're actually losing money. So you're actually losing money on a real time, your real return is negative. And so we need to reduce our inflation. It needs to be single digits, and we need to go back to less than 8%. Ideally, we should be aiming for 4 or 5% max inflation. I think we can reach that. Kenya is a good testament to a strong inflation regime. And so we need to ensure that inflation is low because it affects everything else. Even the MPR rate, that is quite high, is a problem. Businesses are suffering. And so when you're saying, what is the macro environment for investments to come? Investments, chase opportunities. And if you're in a situation where, you have businesses that are also not able to borrow responsibly, very few businesses can, genuinely take on, because most businesses have margins of 10 to 30%, right? And when you have you have interest rates now at the banks at mid-30s. Most businesses can't actually afford to take those loans that they're taking, and so you need to have a low inflation. Lending rates have to be affordable and reasonable, and you have to remove those FX controls. So I'll say those are some of the things that I would add to this in terms of if you want to see long-term capital flow. And the last one I'll say is a very, very predictable regulatory regime, right? We've recently seen this new introduction of the capital gains tax as an example, right? I don't recall that there was a ton of discussion on it with the community, whether it's with investors, and thought about it. But the reality of it is when you have a very high tax regime, right? People are already having conversations on how to ensure that you're not paying this amount, right? Because if you think about the alternative, right? People can set up in Mauritius, they can set up in Dubai. There are other jurisdictions you can set up to get a favorable tax regime that is more predictable. So it's very important, from a regulatory perspective, that you really think about competition, because capital can flow to Mauritius or it can flow to Nigeria, right? And people are going to make the best decision based on, many factors. So I'll say, really a predictable regulatory regime is important. And there needs to be a lot of consultation between the private sector and the government in sort of deciding, and coming up with an adequate regulatory regime, because it's not just, taxes, like I mentioned, but it's just doing business has to be improved, in Nigeria significantly to see more capital flows. And a lot of the time, one last thing I'll say is that we think about it as attracting foreign capital. And I actually think that we're in an era of domestic capital, and we should really, really focus on our modes, which is like, let's focus on how to harness the existing domestic capital into Nigeria. Well, it's already in Nigeria, but let's ensure that it's going into productive assets, right? And so I would focus, there's a focus on saying, yes, let's get foreign capital in. But I think, if you think about the ease of doing business and ensuring that you're just having a regime that's also friendly to local capital, I think that would be a great, sweet spot where you're thinking not just about foreign capital, but very, very much so about local capital and how to ensure that local capital is actually brought into the real economy as well. Thank you.
Okay. Thank you very much for that. That was insightful. I'd just like to get Funke's quick thoughts on this. Just if you have, anything you want to add, maybe from the structural or regulatory side, especially from your, corporate finance background and deal execution standpoint.
Thank you. I think, look, Amaka did a fantastic job. She took a lot of the points out of my mouth. When you think about being able to attract large-scale capital, the first thing really is that credibility and consistency in our policies. When I speak to international investors and those that are looking into the country, some of them will tell you that they need at least 5 years of consistency to be able to come back into Nigeria because they've been, for lack of a better word, burnt in the past. And so what they would say is, we've seen the reforms that have been put in place, but we're watching for the next 5 years before we can come in. So they really need to see that consistency. I also agree with Amaka about I guess, the new emergence of your local institutional capital. Over the last couple of years, we've seen a remarkable number of exits of multinationals, especially in the operating sector, and the reasons are well documented as to why they would leave the economy, foreign exchange and the like. But what it has created is really something genuinely interesting for those with local capital, with real assets, to be able to drive the market. So I think that's a very key point. And I think, yeah, on the point from a regulatory standpoint, there's also that lingering concern about retrospective regulatory changes, where a regulation has been put in place and there are concerns as to, there's a new tax act. Is it supposed to start from 2026, or are we going to retroactively apply it to 2025? So again, as an investor looking to deploy capital into this market, there needs to be a little bit more clarity and certainty, because if you put your money in, you've built your model, you want to at least have a sense of what to expect. And without that clarity, it makes it difficult for folks to commit money to this country.
Thank you very much. Okay, so I'm hearing that, in as much as we're trying to attract foreign capital, there's still a lot of domestic capital that we need to actually harness and see, how much it can unlock more growth in the economy. Okay, so just moving on, to you had already mentioned regulatory reforms. So I think that's a good place to still stay on. If we're moving into the regulatory environment, because it's central to everything, that we've been discussing. Steve, you follow policy and regulatory developments extremely closely, and you're regularly commenting on it on the media. How would you say recent reforms have actually improved predictability, transparency, and investor confidence? And where do you see any gaps, if any, still remain? Thank you.
Okay, thank you so much. I think what we've seen in I'll say the advent of what we've seen in terms of regulatory reform from 2025 till now has been positive, either from PB, Central Bank, SEC, PENCOM, and insurance. So we've seen quite a lot of reform change, and we've seen how some of these things have actually been very positive to the growth of some of those sectors. For example, in terms of systemic risk, the SEC rules, which have actually been released, but a lot of them actually will take maybe active from 2027, is one of the areas that I think we've seen quite a lot of significant development. And we've seen players within that sector that are trying to ensure that within the timeline and the time frame that has been set by SEC, that everybody aligns, from the market players on the advisory side, issuing houses, asset management, broker license, agency, and all of those. I think we've seen quite a lot of things changing in that direction. And if you look at it from the reform of Central Bank, I think as the last report released by Central Bank, about 33 banks have made the capitalization numbers as of March. So I think it's only positive to attract a lot of investments, and it gives a lot of confidence for quite a lot of investors to look at Nigeria. And that explains why we've seen the movement in the NGX. We've seen quite a lot of interest play in that area. We've seen our market cap move to the threshold of 100 trillion and above. So this is positive for Nigeria markets, and it's positive for a lot of things that we're looking at from our side as a business as well. Because as long as we are getting this reform out, implementation of those reform and the market players, how they actually key into those reforms is very, very important. So, and the strengthening of those enforcement powers from all the regulators is actually very equally important. And we've seen how the regulators have been very adamant on the timeline set and ensuring that some of those timelines are met without being shifted again. I think the typical example was what we saw in the insurance company when the first recapitalization exercise was announced. It was quite difficult for a lot of these insurance companies to meet that deadline, and we had quite a lot of fireworks when it comes to people taking the regulators to the court. But now I think from the movement we've seen and how all the players have actually came into that particular drive, it looks like everything is positive, and we can see that it can only generate a lot of investment and positive vibe for the economy. So for me, in terms of regulatory changes that we've seen, I think it's positive. The only gap or few gaps that I'll mention will probably be in terms of how the back channel of engagements between the market players and the regulators has been handled. I think we still need to have a lot of improvement in that space where there are better engagements between the regulators and the market players. Because most of the time you discover that the regulators are somewhat lagging behind in terms of innovation and creativity. And some of the time, the creativity and innovation is coming from the market players. So sometimes the regulators are looking at the space in a particular way and they want to regulate in a particular direction. But the market players will say, yes, we agree with that, but we need to look at X, Y, Z and how we can move the market forward. For example, I think if you look back to before we started having development of some of these derivatives products that are used as hedging products in Nigeria, especially for foreign investors who are particularly concerned about risk. When I talk about risk, I'm talking about the currency risk. The market players were doing some of the edges in terms of derivatives products between themselves and among the few investors who are coming to Nigeria and looking for some of those solutions. And we had a situation where the regulators were lagging behind when it comes to developing the framework that will make some of those hedges products actually work. But along the line, the collaborations of the market players and the FMDQ at the point actually made that happen, which was what resulted in the creations of the future market in Nigeria a few years ago. So for me, that lag in terms of collaboration between the regulators and market players needs to be worked upon. And if that is done, I think with transparent resolve, we believe, and I believe strongly that we're going to see a lot of much more improvements both on the sector and across all the sectors in Nigeria. Thank you.
Thank you very much. So Amaka, from a venture and development finance perspective, would you say that these reforms have moved the needle for the kind of investors and entrepreneurs that you work with? Just briefly, if you could share your thoughts. Thank you.
Sorry, can you repeat the question? So have these reforms moved the needle for who?
For the kinds of investors and entrepreneurs that you work with, and if you just give us, in a nutshell, basically.
Sure. In terms of, I would say not yet, right? I think, Funke said something very important, which is when you make a reform, people want to see it happen over a long term, right? It's not enough to make a change and say, 1 year later, everybody comes in. everyone wants to see what is the long-term outlook. We have an election year next year. Anyone that is serious is looking at the elections, is actually waiting to elections to say, let's figure out if we're going to have a change or what's going to happen, or, everyone is waiting. And so the reality is that, from a foreign investor perspective, I think we've made moves in the right direction. I would say people think it's trending in the right way. We've seen the FX actually appreciate. It's actually good to see that Naira is appreciating. But I think that there's still fundamental questions that need to be answered. It's good that we have our FX reserves are going up. So let's look at the fundamentals of what drives whether it's the FX stability. I would say yes, it's good that we have strong FX reserves. However, we don't have, as a country, we still don't have clear visibility into, our net reserves, right? What is it that the country actually owes to, whether it's via PPPs and things like that. So you don't even have full visibility into these reserves. I'm an economist by training, and I think we've been calculating these reserves the same way we've been calculating for the past, 20, 30 years. And effectively, no one has true visibility, because even the Ministry of Finance is still figuring out, who we owe, across the various contracts that we have. And until you have that, you don't have, you have a reserve number that is meaningful until one day you have a lien on those reserves and you realize that it's not enough, right? So I would say that we need to, there's some fundamentals in terms of how we run the country that need to be addressed, right? One is even how much we make as a country. We still don't have visibility into how many barrels of oil we produce a day, and how much we're making from oil. Even if we're going away and moving away from oil, but I think it's still a very valid point in terms of these are the things that investors are looking at, right? Like, is there full visibility and fiscal transparency into the government's operations? We are we're looking at the debt of the country and saying, is it sustainable debt, right? Because another thing that could impact us, I mean, we've seen almost neighbors, Ghana, also go through this debt restructuring. And there is a question, yes, if you look at debt in the same way every, Western countries look at debt, yes, our debt ratios are low. But realistically, what we should be looking at is the debt servicing, and it's quite high. And it's quite punitive still at the moment, right? So we still have a question of, fiscal sustainability is still a question mark, right? I think if we didn't have the refinery, the Dangote refinery specifically, we would have been in a much worse position as a country right now, right? And this was not through government intervention. So I think on the macro side of things, there's still quite a bit that needs to be done to ensure that there's true stability within the economy. We need to actually be a more export-oriented economy. I think we're moving in the right direction, but then we have to solve some systemic things like power, right? And ensure that we can actually industrialize and manufacture within the country. So I'll say in a nutshell, there's still a road to go. And if you want to convince people, there still needs to be a lot more reform that is done on the macro. So I think the government does still have a bit of work to do. However, most investors don't just see the risk, right? And so our job is to say, these are the risks and we understand the risks, but these are the opportunities. If you ignore Nigeria, right, you've ignored effectively where most of the upside and growth is going to come from in the world globally in the next 50 years, right? So Nigeria, we have a massive population and growing population. Our tech talent is huge. There's innovation happening in Nigeria specifically. And so you can't really ignore Nigeria as an investor. And so people are actually focusing now on, how I say if one to say, okay, how do we realistically, attract investments? You really need to showcase that, one, you're able to mitigate those risks, right? The macro risks within your individual portfolios. But also you have to showcase that even within those risks, there are massive opportunities, right? And we've talked about some of these opportunities, and they're there. I mean, we talked about UAC Foods and how it grew from 81 billion to over 700 billion naira revenue. That's a massive opportunity for an investor, right? Dollar adjusted returns. So the reality of it is that there are great companies being built on the continent, irrespective of the macro. And a lot of our work, unfortunately, as investors, is ensuring that our own, ultimate investors understand that there's a massive opportunity here. But the truth is that there's still a lot of work that needs to be done on the macro. And it takes time. You need to do reform over a long period of time for people to see that these reforms are actually here to stay. So in a nutshell, no, I would say that we've not done enough to tip investors that we're going to be skeptical. What I think will tip investors and what continues to tip our own investors, because we're backed by DFIs and also local and foreign DFIs. And what has tipped the scale is really the focus on the massive opportunity that is on the continent and the ability to actually mitigate these risks, within your portfolios. It's very possible. We talk about FX risk as an example, but a lot of the companies that we are investing in have hard currency strategies where they're exporting and they're earning hard currencies as well. And so we're able to mitigate some of these risks within our portfolios. And that, I think, is what is tipping the scale in terms of getting investors to come in. The second thing I'll say, again, to just really focus on local capital is that we need to de-risk we need to de-risk investments with a focus on local capital. Pension funds, I think, are sleeping assets in our country. They're sitting on, a ton of assets. And the reality is that, they should not be doing massively risky investments. That's not their mandate. And so there needs to be a thought process on how do we de-risk investments for pension funds to unlock that asset. Because they're already here, they're looking for investments. In fact, their existing investments are giving them negative returns, right? So everyone is incentivized to ensure that you can really invest in assets that are producing. And I would say that, if we're to make a difference, I would say that, let's focus a lot on how to unlock, whether it's, guarantees, risk frameworks to sort of unlock pension capital. I think that would be that would really see a lot of investments come into the real economy.
Thank you very much for that. I'm hearing, at the end of the day, transparency, investors want to see a transparent market that can be tracked on actual metrics. Okay, so just let's shift from the regulatory environment into the practicalities of, I think, executing deals. Funke, in your experience across M&A and corporate finance transactions in Nigeria, what due diligence gaps most commonly undermine deal certainty or post-acquisition value creation? Where do you tend to see buyers get, caught out?
Yeah, thanks. It's a good question. I think for our environment, before buyers being cut out, what I would even say and recommend is they should surround themselves with what I call a galaxy of stars, which is the quality of your professional advisors and the team that is working with those looking to deploy capital on transactions. So without that foundation, I think your due diligence is sketchy at best. For this kind of environment, for folks, perhaps buying assets, looking at things around land and title are quite key because of the environment that we operate in. But one area that is sometimes often overlooked is the quality and the depth of talent, or let's say management capability or execution capability. Because if you're putting your money somewhere, you want to have the certainty that those that you're handing your money over to have the ability to be able to execute on that. And again, we all know that due diligence is what you see on the desktop, what you see in reports, but there is a huge difference as to facing the lived reality when you go into the business. And I think, this is a webinar about risk and is also useful to price that risk in. When folks look at their due diligence, it's also useful to reflect on things like, let's say, when we look at businesses, shared services. For us, for example, we purchased a business from the Coca-Cola company. So one key focus area would be what services is this company enjoying today that once this relationship is severed would no longer exist, and how does that impact my business, and what do I need to put in place to mitigate that. I think another thing, just speaking about transactions and from a buyer's perspective, what could perhaps speed up the negotiations is something that has become a little bit more recent, is trying to put together a warranty and indemnity package. Because essentially when you're thinking about the liabilities and you're thinking about making claims when you've done a transaction, if you have put an insurance package in place, it sort of de-risks it, because the buyer knows that if I come to make a claim, there is somebody that's going to, the seller knows that there's somebody that would pay for those claims, and it essentially sort of de-risks in terms of execution certainty. So we're very conscious that when you do due diligence, what you see on paper may not be the reality. So putting certain insurance packages in place is something that I also recommend to folks. So I'll stop there.
Thank you very much. And I think you've even gotten a bit into the next question that I was going to ask, but I will still just stay on this with Amaka. I mean, at the venture and early stage level, is the due diligence, is the challenge fundamentally different, or are the same gaps showing up, in a different form?
So, in this, in venture capital, businesses are much earlier, right? And much, they're small, although they're growing to massive companies, but they're, at an early stage in their execution. And we have a problem, I'll say, in the venture capital space, which is a problem where people think due diligence is not necessary. We're coming out of an era where, to close a deal, people were expected to, once you see a company, you like the founder, you like the vibe, you sign a safe and you go. And that has been honestly the ecosystem. And we've, signed, and the valuations are obviously bloated as well. And so we're going, from that era into an era where people now understand that sometimes the numbers people show and tell you are not the actual numbers. And sometimes, the company is not what you think it is. And so I'll say for us at Weave, we always do our due diligence. So we will do a full financial due diligence, tax due diligence, legal and compliance due diligence. And the aim of it is to even identify gaps that sometimes the management don't see. The financial due diligence is always a very big eye opener. So, one thing you always do is just say, okay, we're going to look at your ledgers and ensure that just, match it to bank accounts, right? And just ensure that, if you say you have this XYZ revenue, you can actually, match it and actually trace the revenues to at least 95%. And that one ensures that what you're paying for is actually real. Because how people even calculate revenue is very different. Someone, what is, gross market value, gross merchandise value versus what is actual revenue to you. You need to understand the difference between that, because some people say, okay, this is how much is passing through our platform, but that's not how much you're making, right? And so you just need to ensure that what they're saying is revenue. Even what people say is what their gross profit, is it actual gross profit? And is it, is it all inclusive of everything, your cost of actual sales? And so it's that discipline to ensure that the financial due diligence is very important. It also opens a lot of things that companies don't see oftentimes, which is they need to understand like what units are not making profit, what business lines don't necessarily make sense at the moment. And so we use that actually an engagement conversation to sort of map out what the future looks like based on evidence. The second gap, I'll say, so financial management and is a huge oversight I think most founders have, where people don't have proper books. And so we use that process to actually identify the gaps and work with companies to say, okay, let's create a roadmap on how you ensure that these are done properly. Another big one is the legal. The licensing regime in Nigeria is quite complicated. And so people are typically not actually doing what they should be doing. So they're not well licensed. So a lot of people are missing licenses, are not paying the appropriate amount of tax. In fact, we just did one with the company, had a huge, tax liability as an example. So, there's a lot of, and so if you invest in a company and you find out, after you invested that they have a tax liability that is higher than their profits, higher than their revenue the previous year, then at least you want to know that, right, before coming in. So due diligence is a very important step. It's one that founders typically will push against. Understandably sometimes because they're very early stage companies, but it's a very important one. And I find that the best founders are those that actually enjoy this process and look at it as a process that identifies gaps. And if you see massive red flags, then you sort of walk away, right? When it's like this is not something you can action plan. This is something you can put into an action plan and work on. But if it's something that is a gross misrepresentation of the business, then it gives you the opportunity to walk away. So I'll say the big ones we think about are compliance and legal, and the financial due diligence are ones that we always do as a core requirement before we invest.
Thank you very much for that, Amaka. I think we here at DOE have to agree with you on that point, having your professional advisors on standby, and that is something that we pride ourselves in. Okay, so given everything we've just heard about due diligence gaps and execution risks, Funke, what transaction protections are now considered essential in Nigerian deals? I know you have touched on this a bit, but what would you not sign off on a deal without today that perhaps 5 years ago might have been considered optional for you?
At the top of my list, it's interesting. I would always say that I'm keen to have an escrow arrangement in place, and that just means you have a portion of your deal consideration ring fenced. It's governed by a release mechanism, and it essentially signals seriousness on both sides. Depending on whether I'm the buyer or the seller of the asset would influence the portion that I want to put in escrow. If I'm buying the asset, I'll tell them I want to put between 5 to 10% of the amount in escrow. If I'm selling, I would want the buyer to put maybe 50 to 75% of the amount in escrow. But essentially, that's because of, I guess, execution risk, and funding certainty is one of the reasons why deals fail. There is all of the intention, but without clarity and certainty of funds, everything else falls apart. I think the second thing in terms of protection would be the closing mechanism. So I think folks on the call will be familiar with whether it's a lockbox or a completion account. If you're trying to reduce perhaps deal certainty, folks may want to move towards the lockbox approach. So you sort of pick a date, you lock in the economic risk, and then you have certain permitted leakages that are agreed upfront. And I guess that gives both buyer and seller certainty as to what they can control and what to expect. I think for our environment, and depending on who the counterparties are, a well-structured material adverse change clause is key. Depending on who you're negotiating with, if you put a generic clause in there, given our current environment, there could be one small shift and your deal falls apart. So I always encourage folks not to use a generic MAPE clause, and just have something that's very specific to the nuances of our environment, whether it's currency volatility, regulatory change, political risk, so that they can have the clear carve-outs. For the protection, I think I already spoke about the warranty and indemnity in insurance. Again, this is one that for those that are negotiating, it's taking time. This one reduces negotiation time because it really just reduces that contingent liability overhang that can complicate your negotiations. And I think once you have your escrow, you have a nicely drafted material adverse change clause such that your deal doesn't fall apart because of a frivolous change in the market. You are very clear on how you are going to close. Is it lockbox, completion account, and insurance is in place. I think those are useful ones that work for both sides of the table, depending on if you're a buyer or a seller. So I'll stop there. Thanks.
Thank you so much. So Stephen, from an advisory standpoint, are you seeing clients, push harder for these protections? And, how are sellers and counterparties responding to that from your own perspective?
Yeah, thank you. I think that's a very, very important question, because at the end of the day, we can actually sit here and talk forever, but if we don't have some of those protection in place, nothing would happen. I think from what Funke discussed, I would say she has touched on some of the issues or some of the points that are probably raised. So the same thing we're seeing from our side, where we'll go out there and talking to investors who are looking at different segments in the markets, whether in Nigeria or outside the country, especially in African countries. Some of these things are the issues that are actually coming to play. I think some of the key essential transaction protection for me, apart from the ones that, well, I would say, plus some of the ones that mentioned by Funke, would probably revolve around robust tax and indemnities and warranties. I think it's very, very important, especially considering the fact that we have the new tax reform, which has started from 2026. So broad indemnities will be necessary to cover a lot of undisclosed liabilities, which are related to either VAT, WHT, and capital gain tax. So these are some of the things when we're talking to our clients, we look at it. I think Funke talked around escrow accounts or withholding for liabilities. That's very, very key as well. The last one, but not the least, that I've mentioned will probably around maybe specific labor and pension indemnities, which a lot of people tend to overlook. So explicitly outlining liability for pensions, defaults, maybe union entitlements, and redundancy costs to avoid post-closing industrial actions. These are things that are played out in some of the transactions we have actually looked at. And I think it's very important to put that in perspective when we're actually talking about protection. And when we're talking to clients, some of these things are the issues that we raised. Data protection is actually very key as well. Data protection compliance is very key. And a lot of people, well, not they overlook, but depending on the specific sector you're looking at, especially when you're looking at fintech and a few other companies that has to do with usage of data. So protection is key, and that's part of protection that must be in place before any transaction will move forward. I will stop here. Thank you.
Thank you very much for that. I just want us to maybe quickly run through the last few questions that we have before we throw it to the audience to give them an opportunity to ask their own questions. So I want to spend a moment on currency, and I think earlier on we had already spoken a bit on this, but because it comes up in almost every conversation that you have about Nigeria, and yet it's one of the most, a bit technically complex areas to navigate. Stephen, what hedging or structural mechanisms are investors actually using to manage Naira volatility in transactions today? And how does that affect overall deal economics and pricing from your end?
Okay, we've seen quite a lot of introductions of different hedges for currency risk prior to now. Like I explained before, I think the sophistication of the market, apart from just a few in Africa, maybe South Africa, Kenya, and of recent Nigeria, have been a bit limited. But now we've seen an expansion into some other part of Africa where a lot of people are now getting quite knowledgeable about using some of these derivative tools to actually hedge the currency risk, because there's nobody you're going to talk to whether they're actually investing in infrastructure or they're investing in agri sector or financial sector of fintech will always tell you about the risk involved, except they actually have maybe like their investment index to USD. So this is critical, and some of the conventional tools we've been using around just using the financial derivatives like futures, swaps, and forwards. So these are financial instruments that people have been using to hedge some of these exposure and to actually, create a bit of hedge around their currency, the currency risk they look at. But now what we've seen is a bit of movement from these financial derivatives towards some structural hedging. For example, depending on the sector you're going to, we've seen some advent of development around natural hedging, which means that you'll find a way to incentivize the portfolio companies to source probably maybe 70 to 80% of their raw materials locally to be able to minimize the USD dependency. So this is sector specific. For example, if you're going to agribusiness, rather than just have the entire exposure coming from, whatever the jurisdiction the investor is coming from, you can have that discussion to say, what, the company will source maybe 70% of those raw materials locally to be able to prevent the currency risk. Another one we've seen is what I talked about, USD index pricing, which means that structurally you're just putting that into your first level of exposure when you're having that discussion, especially when it comes to infrastructure and power investment, where some of the tariffs are actually pegged to maybe USD Naira basket. So we have to protect the equity somehow in return in hard currency terms. So, and some of the things that a lot of investors do is looking for some USD index pricing when we're actually coming in to actually price the exposure in or their investment in that sector. So these are basically the few tools that people are using or that we are seeing from our side in terms of people who are talking to from financial advisory space to hedge some of these currency exposure from financial derivatives instruments, which I mentioned earlier, natural hedges, and maybe like USD index pricing. Thank you.
Thank you very much for that. Amaka, at the VC and early stage level where hedging instruments may be less accessible, how do you and your portfolio companies manage this in practice?
So in practice, I would say two core strategies. The one is companies really working on a clear FX strategy, right, and a clear hard currency strategy. We've seen companies really think through how to earn some level of dollar revenue, mostly through exporting something. It could be exporting, whether it's services, technology, physical goods. We have a company that's agriculture, and they're exporting, physical goods out of Nigeria. And so that becomes a clear strategy. It's very important because the reality of the volatility in the past, decade means that companies really have to think through what that FX strategy is. The second strategy we've seen, we work with portfolio companies to achieve is a multi-currency sort of like treasury management strategy. Companies raise capital in dollars. They also receive, and so you can make decisions on when to convert your Naira, how much Naira to keep as a company, how to, whether you mop up excess liquidity and you convert that into dollars and you keep that, as collateral, which use debt, to sort of run your operational capital, your working capital. So we really have to think about sort of an FX strategy or sort of a multi-currency strategy on how to operate your business, right? But the reality is that if you can't raise money, if you can't make money in hard currency in dollars, then it becomes more difficult. And especially if you're not also a price, if you're not a price maker. So some companies are able to sort of say, the reality is our price has gone up to, FX has moved 20%, we mark up our price by 20%, and the market can still afford it, and there's not a lot of drop off in terms of demand. But the reality is that that's very few and far in between. Most companies can't increase prices as much, and so it means that you really have to see a reduction in profitability over time when you have these FX movements. So I think the ultimate gold standard, as for every company and what we work towards, is getting every company to have a clear strategy for earning some sort of foreign currency, at least 30% of your revenues in foreign currency, and thinking through how to export something. We have a portfolio company as an example that has 100% of their revenue in foreign currency, right? So that's an anomaly based in Nigeria. But the reality is we try to get every company to 30% as a hedge. But like you're right, in this space, there are not that many hedges, right? There are not that many hedges. Another hedge we've seen is actually having a country strategy. Now, it's a very risky strategy, as you know, because operating in Nigeria is one thing, but going to operate in Nigeria and Ghana and Kenya, yes, it helps with your with your FX strategy, but it also creates massive complexity for these businesses, and some businesses actually fail in the expansion process. So it's not even a strategy that we would actively promote unless the business is at the point where they're ready for it, right? And that would be typically at the later stages, of the business. So it's a tough market, and it's ongoing in terms of how to manage this FX risk.
Thank you very much. So final question to you all. We spent a lot of time talking about this very important topic, which is basically the deployment of capital in Nigeria. So we'll end on, exits, basically. So we can have the best entry thesis in the world, but if you can't get out at the end of the day, the returns won't materialize. Fuke, in practice, how are investors achieving exits in Nigeria today? Are trade sales, secondaries, and public markets all genuinely viable routes, or is anyone dominating? And I would like to get everyone's perspective on this. Thank you.
Thanks. I'll keep it short, but what I've seen has dominated in terms of exits is the trade sale route, and that has existed for quite some time. The other routes are available, but what we've seen in our market has been the trade sale route, and that has actually held up through all the, economic cycles that we have experienced. The challenge that folks experience when they try to go down that route is typically in pricing expectations. So maybe you have a seller who has built a business during whether it was a high period of inflation and so on, is unwilling to accept the reality of today. Or maybe they were in business when the Naira was 500 and now we're in a different environment. So usually it's the valuation that sort of ends up holding the deals up. But when, seller and buyer expectations are aligned, the trade sales execute. And I think it's also speaking to the point we talked about earlier about this emerging local player where you had the multinationals exit their companies and you have these guys that are well capitalized. We've seen it for the Guinness Tolaram transaction and a couple of others. So I think that's also a very interesting route. But to summarize, I think it's the trade sale. I would love to see the public market as another avenue, because when you have more avenues of exit, I guess investors are more confident in coming in because they know that if I want to do an IPO or if I want to do a secondary sale, it's something that I can definitely achieve. But I've seen a number of these dual track processes that just end up either in a trade sale or a stalled transaction. I know my colleagues I can see them nodding, so they probably have additional perspectives to share.
Okay, so thank you very much for that. Stephen, from a capital markets perspective, what needs to happen for the Nigerian public markets to become a more credible and liquid exit route, especially for private equity and VC investors?
Sorry, I didn't get that.
I said from a capital market perspective, what needs to happen for the Nigerian public markets to become a more credible and liquid exit route for PE and VC investors?
Okay, I think we've discussed some of these issues and some of these points. On top, because for everyone that goes to for investment in any particular jurisdiction, what you're looking at is your returns, and you're looking at apart from the business itself, which you've done your DD and all of that on, your returns and the ease of entering the market and coming out. So for me, the big elephant in the room, which have been addressed sort of in terms of how the CBNs have actually managed to create a bit of transparencies and market discovery when it comes to FX in the secondary markets, is very, very critical to attracting some of these investment and how they look at the investment in Nigeria. So as long as there are avenue and rooms for them to actually be able to exit, a lot of opportunities will come that way. The liquidity that we currently or transparency around the FX regime is very important, and we actually need to keep it up going forward. I know that the projection for GDP for 2026 is around maybe 4.5 to 4.6 levels. But with inflation still locking very stubbornly around the corner, I think a lot of investment or a lot of investors will look at that space and say, how much of returns will that be eventually when they come into to the country? And like I mentioned, the liquidity of when they come in and when they want to go out. In terms of the access to how some of the route to exit has been in the market has been touched on by Funke. Trade sales and secondaries activities have been predominant. Public markets is still very active, but we have limited route in terms of IPOs, but maybe we need to get more of that going forward. I think these are the few points that I have in terms of how to address those issues. And again, the fiscal policy. So the fiscal policy needs to actually work very well for people to actually come in. We've seen a lot of improvement in terms of the monetary harmonization and policy tools being used by central bank, but we still need the fiscal policies to be able to harmonize and have a very good handshake with what monetary policies authorities are actually doing. Thank you.
Thank you so much. Amaka, final word, anything to add, anything you want to push back on?
No, I just wanted to, I was smiling because, when Funke mentioned the pricing, it's, the pricing is always the issue with trade sales, right? It is still the most viable and realistic exit opportunity for every investor. And I'll give some personal, but I'll say at Weave, we invest with the exit in mind, and that exit discipline is very, very critical. And one, in terms of, because you have to determine the exit at entry on two levels. The one is the pricing. If you believe that an exit in this business is going to be at, let's say, $100 million as an example, then you shouldn't be coming in at 50 million valuation, right? Because your upside is, you're not going to get any upside, right? Because by the time you're diluted, there's nothing left, right? So entry pricing is incredibly important. We have, I'll say, if I look at the VC ecosystem, you asked the question is, what can the public markets do to get VC exits? And I think sometimes it's maybe what can the VC market do to ensure that they can actually fit into the public markets, because it's maybe a mixture, right? The reality is that if you look at the pricing in the market, it is disjointed. Like, the VC and private equity and trade sale pricing and the M&A market is just, there's very little alignment. But the reality is that at the point of exit, there has to be alignment, right, between those two ecosystems. And so if you say, you have a company that is making $200K in a year, and then, for some reason, you're pricing them at a $15 million valuation, the reality is that when you're coming to exit, you're not going to get the pricing you want, because that's not how the markets price businesses like that, right? So, sorry, one second. So I think that's the main thing, right? So I'll give an example that is live today. We just heard the announcement that Zenith Bank has entered Kenya, right, through a trade sale. And typically these trade sales are market entry positions. And the reality is that this is a bank that they bought, a bank with $100 million in deposits, 150,000 customers. So it's a small bank relatively, but it's not tiny. And they paid $7.7 million for that, right? Now, if you as a venture capital fund, you're investing in a fintech company and you don't see those numbers and you're not able to understand that that's the reality of market pricing, right? Then if you come in and you say, okay, company that is doing $5 million in lending or in deposits, and you're paying, 20, 30 million for them, knowing that when it comes to a trade sale, people that you're selling to will not price them like that, then you're basically taking away all the exit options at entry. So I would say that in the best deals, the entry point has already determined whether there'll be positive or negative exit, right? So I think that's the first thing on the pricing. and just pricing reality, and just being more realistic on pricing in the venture capital ecosystem. The second thing is also realism on what an exit amount looks like. Typical exits on the continent are not going to be billion-dollar exits. That's the reality. And so you can't price as if they would be, right? And so you need to price, whatever the exit amounts you're looking at, you need to price accordingly. And I'll say the last thing, on this point is that what kills a lot of trade sales is governance and financial management. And so when you're coming into a company, ensure they have the right governance, ensure the financial management is put in place, and you're already putting them at a strong position that when it's time to exit, there is an exit that can be made. And the last point I'll make also is the fact that, really when you think about trade sales, you have to identify the clients beforehand, not at the end, not 5 years after investing. When you're investing, you identify a potential target, speak to them, understand what they would buy, why they would buy a company. As an example, if you're looking at logistics, as an example, people like DHL, they have very clear M&A footprints across the continent and across, globally. And they know what they buy. They buy distribution. They look at 7x EBITDA numbers. And so they have a very clear footprint of what they buy, how they buy, and what they are looking for. So if you're basically going to invest in a logistics company, speak to, potential buyers, and you already know what this company needs to do to make sure that they're in a good position such that in 7 years' time or 5 years' time, a DHL can buy them. So do that work beforehand and let that be part of the value creation that you bring in as a venture capital fund into those businesses. And yeah, in a nutshell, exits are not found, they're engineered, right? And that's our own philosophy and how we invest.
Thank you so much. I think that's such a great note to, end this on. We've covered an enormous amount of ground from capital deployment and sector opportunity, all the way through to regulatory reform, deal execution, currency, and exits. So I know that we can keep this conversation going forever, but I think we'll just take very few questions from the audience, and then we would have our closing remarks. Thank you. Okay. Some reason I'm not seeing the questions on my end. Okay, so Kumar Arun asks, please share the insight from Forex investors' perspective in industries with 7 years of CapEx investment with local currency revenue, potential Forex hedging strategies. I don't know if anyone wants to take that. I think that's a bit broad, but would anyone want to just maybe briefly say something on this?
Can I assume that the question is just around possible hedges for currency risk?
Yes.
Is that the question?
Yes,
Okay.
basically.
Yeah, I think we talked about earlier during the course of presentation. And I mentioned some of the tools, some of the financial derivatives tools that are being used right now by different houses when it comes to hedging some of this exposure. The future market in Nigeria is quite broad right now, has been elaborated by FMDQ during the course of the volatility we experienced in the previous administration. So that tool is still very, very prevalent now among bankers and among any financial advisor that is bringing in. And there are other exchange, I'll put like edge funds or ETFs that have some of these underlying instruments that are tracking some of these exposure that you can use to hedge. And outside that, depending on the maybe the industry specific, like I mentioned earlier. Some of the natural hedges actually can be used using like USD indexed linked to actually hedge some of these exposures. I think those are the few ones that a lot of people can look. But for every transaction, most time when you're talking to the client, you have to look at the transaction specific and look at how you can tailor some of the solution, the financial market or financial derivative solution to meeting those exposure or risk in the market, depending on the jurisdiction you're looking, whether in Nigeria or the rest of Africa.
Okay, thank you very much for that. I hope that answers that. Okay, I have one on my end and says, how common are governance and reporting standard gaps when you enter a Nigerian portfolio company, and how do you fix them without disrupting the business? Amaka, I think you mentioned something on governance, so it would be good to have your response on this. I can take the question again if you want me to.
Please do. Yeah.
Okay. How common are governance and reporting standard gaps when you enter a Nigerian portfolio company, and how do you fix them without disrupting the business?
Oh, they're very common, I would say, and you have to disrupt business. So it's part and parcel. It has to be done, right? Because the reality of taking on external capital is it's a decision. And once you make that decision, there is a level of disruption. The reality is that if you want to build a personal company where you're running it yourself, you have the books in your head and you are doing it in that manner, that's very okay. But the moment you decide you want to take on external capital, whether it be, particularly if it's equity, where you have equity partners or debt, then the reality is that there has to be visibility and there has to be governance in place to ensure that all parties are aligned. And so it's only disruption where there's misalignment at entry. And so a lot of the conversations beforehand are about whether you actually want, as an investor, as a company, to take on investors and take on investment, because it's not for everyone, right? If you take on venture capital funding, it requires a certain amount of governance, it requires a certain amount of financial management. It requires a certain amount of even growth as a business, right? In terms of just how quickly you need to scale so that everyone is comfortable. And there's absolutely nothing wrong with not taking capital, right? And deciding to grow completely organically as a business. And it's a very credible route. But if you choose that you want to take on foreign capital, you want to grow, you want to, whether it's IPO in the Nigerian Stock Exchange or, you do have to incorporate governance and financial management. And it is not necessarily disruptive, but it's something that is actually foundational, right? The fact that you're able to sort of have have proper accounting books, have proper ledgers, know on a day-to-day basis where money is being spent, where money is lost, identify the gaps. These are not bad things. These are not negative disruptions. These are positive disruptions. And I actually like to say that, when you talk about governance, right, as well, people sometimes see governance as a bad thing, and you need to almost do like a founder fit for capital, right? Because some founders do not want governance. And so you need to identify those beforehand and stay away, right? But I think the right founder fit is the founder that sees governance as a moat and as a strength in their business. With the right board, really you have a team of champions that you can call upon to give you advice, to open doors for you, to guide and steer the business, and to really expand that business. So, it's I think governance is a strength, for the right business. It's not a negative disruptor, it's a positive disruptor. And so, the disruption has to happen, but I think it's positive disruption. And a founder that thinks it's negative is probably not the right founder for the funding.
Okay, thank you so much. And last question says, I am keen to know whether and how you're featuring sustainability related risks and opportunities in your risk assessment, and to what extent you're leveraging ISSB standards like IFRS S1 and S2, and or the ISSB industry specific standards. This is very specific, so I don't know if there are any takers on this.
Okay, so maybe I'll say that it's very specific standards. We use, in terms of how we look at every investment, we do have a core sustainability assessment for every company that we invest in. And so ESG is a core, I think ESG is a moat. So companies that really think about sustainability are actually companies that will outlast and outshine companies that don't. And short term might be different from long term. So we're looking at long term outcomes and returns here. So a key part of what we look at is how from a sustainability perspective, we basically follow the IFC performance standards. And so you look at all key elements of sourcing, even things like water management, power management within companies. You look at their economic, their climate footprint, that the companies have. And so there is an analysis of saying, how is this company ESG compliant? And it's not just a nice to have, right? I'll give examples of some things that matter. So let's focus on the S of the ESG, right? The social elements of sustainability. And you have situations where companies are paying below the government's minimum wages. And what you have there is that, yes, you can say, okay, fine, a company like that is fine and it's not an issue. But the reality of it is that this is a company that is not necessarily sustainable. You could get fines, you could get, and it creates a culture, right, within the organization. And so long term, this company probably won't do well, right? So you need to think about things like how they treat staff, how you treat the communities that you work with. So what is your community footprint? We think about even things like packaging. If you're a company that deals with packaging, then we care about literally what packaging do you use. As a recent example, we did an agricultural company, and a big part of the analysis was really around how they work with farmers on sustainability. And they're very big on it, right? So they're big on working with farmers on getting the right inputs, on getting things like solar irrigation pumps, as we talk about. And what they've seen with their own farmers is that the yield is much higher, and they're getting much more return and loyalty from those farmers. And so typically you would have farmers side selling, but because these farmers are getting so much benefit, so from this company, that they're not going to other buyers, they're not side selling. And so sustainability can be a moat, in your business if you structure it the right way, and is a core part of our analysis. But we use, I guess, different standards in terms of how we analyze these companies.
Thank you very much for that, Amaka. I trust that that response has helped our audience as well. Unfortunately, that's all the time that we have. I must apologize. I know our time is fast spent, but what a conversation it really has been. I want to sincerely thank Funke, Amaka, and Stephen for being so candid and so generous with their insights today. This is exactly the kind of frank, practitioner-led discussion that I think the market needs more of. And I want to say thank you to everyone who joined us and submitted questions. Today's conversation really is just the beginning, and we would like you to keep the conversation going. So we would love to hear your perspective. Join the conversation on social media, share your insights, and tag us so we can keep the discussion going. So I'll hand over now to our partner, Adeni Duale, to give us the vote of thanks and closing remarks. Thank you.
Okay, thank you so much, Melody. Wow, Steve, Funke, and Amaka, thank you so much. Those were really insightful contributions. And to everyone who has also joined us today, we thank you for taking our time. I think that as we close this webinar, one of the things that stand out is to basically state, number one, that the ongoing reforms are, in our view, things that are reshaping investment landscape across the country. And so what do we mean by that? We're saying that they lay the foundation for a more stable and transparent operating environment, which we expect to have in Nigeria over time. It's also important to state that risk is evolving. Because risk is evolving, there will always be regulatory changes or execution challenges, So these things will definitely happen. But what must be emphasized is that it is important to have good advisors and hold you through the process. I remember that in the course of this conversation, a lot of the panelists have actually indicated that. Thirdly, I think it will be important to state at this point that we must have a disciplined and well-structured capital, which for investors, every time you feel that you're looking for a jurisdiction to invest in, it's important to know that capital will always be disciplined because it will always look for where it can extract value the most. And I think it's even important to state here that, I think it was last week I was at a session, a PEFCAF session, and Mr. Balogun of Chapel Hill had indicated that a substantial amount of money that was raised during the banking recapitalization of last year was from local sources. So what am I saying? I'm saying that capital need not necessarily be foreign, but what is important to know is that capital will always find its value. So today's discussion has reinforced that deploying capital in Nigeria is not just about identifying the opportunities. It's also important to understand how to navigate whatever challenges that there will be. It will always bring an intersection between risk, return, and execution, because it is within that you now find where the most compelling outcomes will be created. We hope this session has provided practical perspectives to everyone and would support you in your investment decisions as you move along. We thank you once again for your time and your engagement. Thank you for joining us. Until next time, take care.
Thank you.
Thank you, everyone.
Thank you. Cheers. Bye.
Bye.
Thank you.